Well, hey, welcome in everyone. Kevin Hissong here with Rain Over Money. Welcome to episode 12. Today we are going to talk about making our money sweat. And what in the world do I mean by that? Oh, we're gonna talk about working our money out like the old Richard Simmons, getting grooving to the oldies or whatever it was. Making your money sweat, making your money work harder for you when it's just kind of sitting there. If you're lucky enough or fortunate enough or you've planned correctly enough to have some discretionary income sitting on the sidelines, whether it's in a bank account, money market account, savings account, even sitting, or maybe you're looking at opening a taxable brokerage account or something just to invest your money. Maybe I guess I'm talking outside of retirement accounts because definitely we want you taking advantage of that 401k retirement account that you have at work, whatever it may be. Um, Definitely, as we've said before, getting that match, making sure if you're getting a 401k match, make sure you're investing enough to get that match because that's essentially free money from your employer. But outside of that, we talked about in the past, what do you do after that to start to continue to build up your wealth over time? And I'm going to give you a few ideas here. And this is a unique time to be talking about this because if you pay attention to the news, with inflation and rising interest rates, the Federal Reserve has been all over the place, and you've probably become very familiar with this person by the last name Powell, that talks a lot about the Federal Reserve and what their plans are. He seems to be commanding which way the stock market is going right now, based on what he says. But over the last year and a half, interest rates have risen quite a bit, and we've heard the negative side of that. And we've heard the negative side of inflation. Things are going up and everything costs more. Well, I don't know if everything costs more. I was having a discussion with my wife just last night about this. And you think about it, yes. I mean, we are definitely seeing, gas has gone up, groceries have gone up. The day-to-day things that we spend money on have gone up. Even we looked at trying to get maybe a deck done last year, and the prices were just outrageous because of the lumber issues that were going on with shipping issues and everything around that. So a lot of things have changed, but also a lot of things haven't. You think about your fixed costs, like our mortgage hasn't gone up, and that's our biggest payment. Luckily our education payments haven't gone up. Things like that have not gone up. So it's not across the board. You hear 8% inflation, 7% inflation, whatever. It's not 8% across the board. It's mainly on those day-to-day things, goods and services that we're paying for that have been affected. And along with inflation, interest rates have gone up. And what has that affected? That's affected mortgage rates. Anything where you are borrowing money, CD or not CD, credit card rates, as we talked about credit cards last episode. Credit card rates have gone up, so you definitely don't want to be, you want to make sure that you're paying off your credit cards every month so you're not paying those extra exorbitant interest rate fees that are out there. And the same with mortgage. Hopefully you're not in the market to buy a house right now, and if you are, maybe you're lucky enough to be paying cash for it. But us with our 2% 15-year mortgage, we're not complaining one bit because we're not going anywhere. And maybe when the time comes around that we're ready to move around, rates will be back down. But so that's the downside. You hear about the downside of rising interest rates. Well, we're going to talk about how rising interest rates can help your money, especially that lazy money out there. So I've talked about Rain Over Money as this idea of almost like a kingdom where you are the ruler of your kingdom and you've got this walled castle around your money, and every now and then you want to send your money out, and almost like people or soldiers, you want to send that out, and have your money or your people bring back more people to your kingdom. You want your kingdom to grow from maybe 5, 10, 15,000 people to 2, 3, 4 million people over time. And that's the analogy with investing and growing your wealth over time, is reigning over your money. So, maybe, keeping with that analogy, you've got some folks that live in your kingdom that like to take a lot of naps, like to just, sleep on the job or whatever it is. That's like lazy money. That's money sitting in your bank account that is just sitting there earning zero point zero 0.01 in interest, 0.05 in interest if you're lucky. And we can't be having that. I mean, we need all of our money or as much money as we can working for us. Now, if you've got emergency fund that you've built, that is a great idea to have an emergency fund to cover, 3 to 6 to 9 months costs, specifically, more short-term cost. You want that money to be fairly liquid, meaning you want easy access to that money. Yes, that's money you should be keeping in your bank account that you can easily get to. But if you've got maybe some longer goals out there, a year, 2 years, 5 years down the road, you've got some money, maybe you don't want to invest it in the stock market because the market's obviously been up and down lately and this and that, but you would like it to be earning a little bit more money. I've got some ideas for you on that. And that's what we're going to start with right now. So I was just out looking, and this is very timely for myself because we are looking, to put some money away for our property taxes. We pay our property taxes. We don't escrow anymore. So our property taxes are due in November. We'll owe about 8,000, 8,500, somewhere around there. And I'm just looking for somewhere to kind of set that money aside for 6 months to earn a little bit, so that it's ready to come due. I can take that money out and then off pay off the property taxes. So I was out there looking today through my E-Trade. I love E-Trade. E-Trade's what I've always used. You may have your own accounts, or you may, call up your broker for questions, whatever. But I was looking at treasuries. You may have heard of U.S. Treasury notes, U.S. Treasury bonds, U.S. Treasury bills. Bills are the shortest term, then notes are a little bit longer, and then Treasury bonds are the longest. I was just looking at Treasury bills out there today, and you're looking at around 4.5, 4.6% as stated as the annual yield. And I know a lot of people get confused when they hear the term yield. All you have to do to think of yield, it's an interest rate. It's kind of dumb how they do this, but interest rates are on your mortgage. Interest rates are on things you pay. Yield is on things you earn. But if it makes it easy for you, just think of it all as interest rates. That's what I do. So I can get roughly 4.5% over a year if I buy some Treasury bills today. The thing to remember if you're buying Treasury bills, if you're buying CDs, whatever it may be, and CDs are certificates of deposit, usually at a bank, but you can buy them through a brokerage firm as well. All these things are stated as annual percentage yields, APY. Just think of it as that's what this is going to pay if you held it for a year. So if I'm looking at, to hold a treasury for only 6 months and it's a 4.5% annual yield, I'm going to get somewhere around, like 2.35% for my 6 months. But hey, if I'm putting $8,000 away, I'll take 2.3% on that money for 6 months, and that money will then come due. I can pay my property taxes with it, and whatever little bit I made off that, hey, maybe that goes to Christmas or something, because ours are going to be due right around the end of October, November. And that's the nice thing about treasuries. They're very flexible in the time periods that you can buy them. You can buy 1 month out, 3 months out, 6 months out. It's all available out there. But again, everything you're seeing in terms of yield is an annual yield. So you have to divide that by however many months you're going to be using that device for, that investment vehicle. And that goes for CDs as well. CDs right now are fantastic. If you've got some money, maybe you want to put away for a year. Again, E-Trade, I was seeing up to 5.3% as an annual yield on a CD, meaning you put $10,000 into a CD, you're going to earn $535 on that money just for letting it sit there for a year. I do always recommend checking out and making sure with CDs that they are no penalty CDs. So that should you need that money early, you can get access to it without paying a penalty or a fee. So that is one thing you'll want to look at as well. And you can buy CDs just with cash. You can buy them in your IRA and so on and so forth. I don't personally buy them inside my IRA or retirement account just because that's money further down the road. And that's money that I'm trusting with the stock market and growth over time in the stock market. But yeah, for short-term money, just cash on hand, transferring it into a bank. I mean, you can go through Chase, you can go through Capital One. You can check your own bank. I know a lot of banks are not offering great CD rates right now, but there are some out there that definitely are. Like I said, Chase, Capital One, and then through E-Trade, they were listing multiple ones out there that they uh, offered their CDs through. So I don't even know some of the banks. But as long as you're going through a bank that's FDIC insured, obviously there's been some stink about banks lately, but you know, a bank is FDIC insured, so your deposits are guaranteed. I believe it's up to $250,000. So you shouldn't feel too iffy about that, especially a reputable bank that's out there. So again, CDs, great way to do it. Treasuries, great way to take advantage of rising interest rates right now. And that's the thing is you really, with the way your interest rates are right now, I don't know if you necessarily want to hold it for a long period of time. I don't know if you want to be buying 10, 15, 20-year maturity dates right now because, these interest rates, if we knock inflation out and Powell feels and the Fed feels that it's under control, we may see rates come down fairly quickly. I don't know. I'm not I don't have a crystal ball, but if we did see that, then you wouldn't want to be holding 20, 30 years out potentially, is just my thought. Keep it short term right now would be the best suggestion I could offer. So that's, CDs, treasuries are great ways to go. Make your money sweat a little bit. If you've got some extra money sitting in the bank account you were thinking of doing something with, great way to earn a little bit extra and take advantage of interest rates. So now I want to pivot from that. I'm not going to spend a lot of time on this side of it, but kind of the next step after these short-term treasuries and short-term CDs are bonds. And I think a lot of people think bonds is very confusing. I feel like everyone kind of has a general idea of how stocks work. I mean, there's a lot that goes into the stock market and how individual stocks work. But bonds can be confusing to people because you've got these different yields and yield to maturity and the different prices of bonds that fluctuate over time, and this confusing inverse relationship of when interest rates rise, bond prices fall, and vice versa. When interest rates go down, bond prices go up. So if you're invested, for most people, your exposure to bonds are some type of bond fund or bond ETF in your 401k. A lot of individuals don't purchase individual bonds. And I don't know, that may be a generational thing. I mean, bonds were a very big deal in the 60s, 70s, 80s. And I even know when I was on the retail side, I would say those that were from an older generation are much more apt to take a look at bonds because they believe in them. I think that, those born in the 70s and beyond, we are much more believing in the stock market versus the bond market. But that being said, bonds can be a good way to go as an alternative to stocks because a lot of times the bond market works in inverse to what the stock market is doing. But what I want to talk about is when I got into the retail side of business, one thing that actually was very interesting to me were tax-free municipal bonds. And this gets into folks that are earning a little bit more money and start to be much more concerned with the taxable income they have coming in and want to find ways maybe to make money on their money, but to shelter what they're earning from taxation. And one way is through municipal bonds. Municipal bonds are unique in that they can be offered by different entities at the state level, different entities within a state. You've got two different types. You've got general obligation and revenue bonds. And, it does get a little confusing. But actually, one of my longtime favorite investments has been a symbol called NVG, like Nancy, Vic, George. It is a basket of municipal bonds. It's actually called a closed-end fund, and you don't see a lot of closed-end funds anymore. Just really think of an ETF or mutual fund. It acts very similar to that. It's a basket of municipal bonds because I don't want to go out and select municipal bonds myself. I mean, I could, but I don't really want to at this point in my life. So I'll trust the experts to selecting these bonds. And what it does is you're going to get income derived from these bonds. Think of it as an alternative to a dividend. So on stocks, some stocks pay dividends. The profits they make, the revenue they make, they spin off and send some of that back to their shareholders for investing in their stocks. And this is very similar to that. But this is just the interest that's being generated from the bonds. And why I've liked this one for so long, NVG, and it's Nuveen Municipal Credit Income Fund, just so you know. And there's other ones out there very similar to it. It pays 4.41% as a monthly tax-free interest payment. So that 4.41 again is annualized. So let's say I've got $10,000. I invest $10,000 in that. I'm going to get $441 tax-free from that investment. Now that tax-free, that's going to be federal tax-free. I may pay state taxes on that unless all those bonds were, in my case, in the state of Kentucky. But federally tax-free, $441, which is very cool because you have to look at tax-free interest rates a little different because CDs, dividends, all that are taxable. So if that's taxable, you've got to pay taxes. Your current tax rate comes into play there. But tax-free at 4.1%, 4.41% could be the equivalent of 6.5% on the taxable side. I hope you kind of follow me there, but we're trying to compare apples and oranges here, and it's a little bit tough. But if you're not paying state taxes on municipal bonds, they can be very handy. So that's one option I like as well. I like that it pays monthly. What I do is called a dividend reinvestment plan, or DRIP, dividend reinvestment plan, DRIP. If you don't need the income right now, but you're investing in something that is paying you income, you can reinvest those interest payments to you and buy more shares of what you own. So in this case, when we get a payment from Nuveen on a monthly basis for this muni bond fund, we've got dividend reinvestment. So it goes back in and it buys more shares. And over time, it's continuing to buy more and more shares. And the more shares we buy, the more dividends we get. It's like a self-fulfilling prophecy. You see where I'm going with this? Over time, if you're willing to hold these long enough, you can really start to build up a nice income stream. And that's what's exciting about it. So that's just a precursor to the next thing I want to get into, which is my all-time favorite. But that's kind of how tax-free munis work if you hear the term out there. The last thing I want to talk about real quick on how to make our money work a little harder is dividend-paying stocks. Now, if you've got money on the sidelines, maybe you've already got a CD, but maybe you're looking for a way maybe to generate a little bit more growth potentially in the stock market, but you don't want to jump into the Teslas of the world and NVIDIAs and other things out there that are a little bit more aggressive. Maybe you're looking for something a little more constant. And this represents me in my investment philosophy. I love boring. Boring is good when it comes to investing, even in stocks. Some of my all-time favorites: Illinois Toolworks, Johnson & Johnson, AT&T, American Water, which is the AWK is the symbol on that. Just to give you an idea, I mean, these are boring companies, but they have served us very well over many, many years. I'll give you an example of how dividends work. Again, dividends are a payment by the company, and not all stocks pay dividends. If you go out and look at a stock price or a stock quote, for instance, you pull up Illinois Toolworks, ITW. It's going to show the current price of it, which I think is around $230 a share. It's going to show the dividend yield, or again, that's the interest essentially they're going to pay you for holding the stock. It's around 2.28%. And it's also going to show you the actual dividend payment. It's $5.24. That's the current dividend of the company. So you own one share of Illinois Toolworks. You are going to, over the year, get paid $5.24 of dividends. Doesn't sound great, but let me show you how this works and why this is so important. Another one, for example, let's use Target. We all probably know Target. It's one of everyone's favorites. We can easily go there, wanting to spend $20 and easily spend $200. Its current dividend yield is 2.73%. Now, right now, it's about $158 a share, and the dividend payment is $4.32 a year. Most stocks pay their dividends quarterly, so you always want to divide that annual dividend by 4. So their quarterly payment is $1.08. So for every $100 or for every share you own, you're going to get $1.08 a quarter. So you own 100 shares of Target. Now you're talking. You're talking $108 a quarter in dividends, or $432 per year on 100 shares of Target. What's cool about Target, what's cool about Illinois Tool Works and another 50 or so companies out there is they are part of this group called the Dividend Aristocrats. And the Dividend Aristocrats are companies that have continued to increase their dividend every year for at least the last 25 years. So what that means is sometime this year or sometime next year, if they already have, Target most likely will increase their dividend. That is to help stockholders keep up with inflation, keep up with the cost of living, if they're relying on this money for income. So they will raise that $4.32 a year. Who knows? They could raise it 5%, they could raise it 10%, but if they raise it 10%, they're going to raise it 43 cents or 10% of $4.32. So now their annual dividend becomes about $4.75. So if you were making $432 a year on your 100 shares last year, now this year coming up, because of that dividend increase, you're now making $470. They've given you a raise. They've given your money a raise. And there's nothing you're doing other than investing in the company and letting it sit there. It's passive income at its best. It's letting your money work for you, whether it's stocks, municipal bonds, CDs, treasuries. There's lots of ways to do it. And I know I'm trying to cram all this into 20 minutes as an introduction, but I just want to give a precursor. We will spend an entire episode just on dividends, and I'll talk more about how we've developed our income plan over the year through the years through dividends as well. But a great idea, a great way to start, and I hope you find this valuable. If you got some money sitting on the sidelines, get to make it work. There's plenty of places to earn a little bit of money that can be effective. And from a risk standpoint, you can gauge that risk from just investing in U.S. Treasuries to bank CDs to municipal bonds to the stock market and so on. So a lot of different options out there based on your time frame, risk tolerance, and everything that goes with that. So that's what I wanted to cover for today. Again, we're making our money sweat. If you got any comments, anything I missed, anything else you'd like me to cover on this, got any questions, whatever, please feel free to shoot me an email at contact@rainovermoney.com. I'm always out there on Twitter, or on Twitter handle at rainovermoney, and visit the website for additional information, additional tools. I'll have a list of the dividend aristocrats out on the website so you can see what stocks fall under that. And from time to time, some are falling off and some are going on that list. But it's a nice list to keep an eye on. A lot of boring companies that you'll love, I promise you. With that said, thanks for joining us for episode 12, Making Your Money Sweat. I'm Kevin Hissong, Rain Over Money. Like, subscribe. Thanks for joining. Take care. We'll see you soon.